All right. Good afternoon, doctors, as well as practice managers. Greatly appreciated for joining our special webinar today. We've got a great special guest in covering something that is certainly very, very top of mind with all the upcoming changes and policy changes specifically to taxation. So very, very excited for today's webinar entitled Cost Saving Strategies for the Health and Longevity of Your Clinic. My name is Eric Polk. I manage the Healthcare Leasing team here at Cirrus Consulting Group, and I'm joined today with Andrea Chan, who is a CPA and CA and a partner with MNP. MNP is one of the largest accounting firms throughout the country, and Andrea has some fantastic experience working one-on-one with doctors like yourselves throughout Canada, specializes in creating customized plans, especially if you're looking to purchase or start a new clinic or animal hospital or whatnot in the near future. And certainly it's very important to get things set up properly from a tax perspective, setting things up right or getting it properly set up, as especially with the upcoming tax changes, or establishing corporations, salary dividend mixes, as well as, of course, estate and trust planning, as many of you may be potentially looking to retire, transition, or sell your clinic in the near future. So we're going to touch on a wide variety of topics, but really focus on making sure that we're cost-saving strategies, especially in this turbulent time of change. So welcome, Andrea. Great to have you. A little bit about Cirrus. For those of you that don't know, we are really the premier healthcare tenant representation firms for vets throughout North America. We have, and have been doing this now for about 25 years. So we were founded by healthcare professionals for healthcare professionals, specifically because of the need of doctors needing proper representation to have their businesses protected and not to be taken advantage of by landlords, right, or anybody looking to, craft the leases that weren't being properly reviewed, and to protect that individual business and clinic. So what we do as an organization is we analyze thousands of leases each year, making sure it's specific to being medical, dental, or veterinary specific. And we also represent about 1,000 practitioners on an annual basis, and that typically are both those that are a tenant or those doctors that also own their building and have a separate corporation for their landlord and for their building, differing from their professional corporation, and making sure that there's a proper lease in place today, which can be beneficial from a taxation perspective, from a liability perspective, as well as certainly from an end valuation perspective, especially for those looking to retire, and making sure that that can be a continual investment or annuity if you're selling the practice without selling the building. Our track record is second to none. We have successfully negotiated over 10,000 office leases now over the past 2 decades, and the amount of intellectual property from the smallest mom and pop landlord to some of the largest institutional investors is giving you a great advantage. And of course, these courses, such as this, continuing education courses, we do approximately 150 per year to help support and ensure that we're continually growing that the continual education. In terms of the agenda, what we do first and foremost is make sure that to help determine if you are overpaying in rent today. One of the largest single checks that you'll spend in your animal hospital or clinic typically goes to the landlord. You have your sundries, you have your HR expenses and payroll, as well as your costs for your real estate. So what we want to do as well, touch on some of the additional risks, negotiate and how to negotiate the best based rents and terms for your veterinary office lease, and help understand if your operating costs, such as common area maintenance fees, are fair and accurate, and making sure that they are auditable, and make sure that you're not overpaying, as we do find that many of our clients are paying more than what they're contractually obligated to. Last but not least, negotiate strategies to facilitate the profitable sale and the eventual transition, let that be to a family member or to an outside entity, corporate or individual. So doctors, one thing to think of is, what is a lease? What is a lease? When it boils down to it, when most of you looked at your lease agreement or are going to look at it for your new practice, you might typically only focus on the first half of the first page. That focuses on who is responsible for paying, who that it is going to be paid to, what cadence or how often that's going to be paid, and for how much. So in essence, the way to look at the lease is as a check, as one of the largest single checks that you will pay in your professional career is to your landlord. Not uncommon when looking at a $2,500 to $3,500 per month lease, and we all know that they never go up on an annual basis. Right? In this case, from that perspective, it's critically important that we are looking at the total cost and how valuable you are to the landlord. Right? Not uncommon that over a 25 to 30 to, in some cases, a 35-year career, that you will be spending upwards of $1 million to $1.5 million just purely in rent. Therefore, it is your obligation and, quite frankly, duty to ensure that the lease is properly negotiated, your interests are properly represented, and that you are helping to minimize this total check because you are about to invest or are currently investing an amazing amount into just being in that space. So let's think for a second, why is it so important? Yes, it's a necessity, of course, because the location is your business and your business is your location. So therefore, to establish it, you are reliant on that business. Imagine for a moment if you received a letter that said you have 30 days notice to either move or be relocated or move out of that building. What impact would that have to all the marketing you've done, to all the goodwill, to all the repeat clients you have, right? What impact would that have to your business? In addition, you've invested heavily into that space, right? To build out a new clinic these days throughout North America, not uncommon to see $100 per square foot, $125 per square foot, right? Representing hundreds of thousands of dollars of initial cost to build out that new practice. Because of that, right, you want to make sure you have long-term predictability and continuity to ensure that your practice is protected and you can recoup on that significant investment. And it is, as mentioned before, very difficult and time-consuming and expensive to move, right? Imagine if you needed to move the practice in a 30 to 60 to 90-day increment, what would you do first? What's the process? What would the fees be involved, right? What are all the additional costs to ensure that the practice is relocated successfully? Right? And especially, last but not least, we'll touch on the value of the practice as well as how important it is to the sale. So on that note, for the upcoming sale or long-term sale of your practice, what would you say are the three most sellable or critical components of your practice sale? Well, when doing the valuation, and working with some of the professional partners in evaluating your property and your business is based on, first and foremost, the equipment. What are the tangibles? What are the current costs? What is the depreciated cost of the assets? Let it be to some of the x-ray equipment, surgical equipment, physical things attached to the space that you've purchased to put in there. What are you physically selling and what is the value for that? That's pretty straightforward. The next component is a little bit more subjective, the goodwill, right? This comes down to the predictability of revenue that the new incoming doctor would be purchasing in order to understand what the revenue stream should be, assuming they don't mess it up and assuming that the patients continue to show up like clockwork for the annual exams and making sure that they are brought in with their owners and that the owners continue to make sure that they're bringing in their dogs, cats, and animals, right, into the individual clinic and to look at the patient charts, you know, how recent that they've been purged and how likely they are to continue to be there. And one of the most components which quite frankly can impact 100% of your practice sale. Can anyone guess? Your veterinary office lease. This is the one thing that we see when it comes down to a practice sale or acquisition that can delay the process or can stop the process in its tracks is the lease. Why, you may ask? Well, for those of you with your lease in front of you, I would encourage you to look at the assignment and subletting section of your lease. This section clearly defines if or how you can sign and assign your lease. So when you sell your practice, if you are Dr. Smith and you're selling it to Dr. Brown, one of the key components involved are that the practice is contingent on the lease being assigned and transferring on to the new doctor. To do that, you will typically need the landlord's written approval, and therefore they hold the cards. And depending on how your lease is defined will determine how much the landlord can require or how picky they can be to choose who is going to come in and occupy that space. And unfortunately, landlords now are becoming quite enterprising and are seeing the value of practices selling $500,000, $1 million, and beyond at 100% of production, or in some hotter markets, 110, 120% of annual collections. And they're doing their best to, believe it or not, even try to collect a percentage of the sale proceeds because of how the lease was designed. So definitely, I strongly encourage you now or afterwards to clearly look at your lease, specifically the assignment and subletting section. So let's touch on that as we look at that as an example. So rent and other costs of the lease. So one of the first components are the annual base rent. So when you think about it, how much are you spending? If I asked you today, how much are you spending in total, and what is the breakdown of what you're spending to the landlord, how many of you could give me an accurate value within, call it $100? Unfortunately, right, you are spinning 101 plates, and it can become very difficult to know how much the increases are, or where that money is going. So primarily it's based on the base rent. That should be clearly defined in your lease, as well as the amount of the increases associated with it. So aligned with that is to make sure that the costs involved are in fact reasonable. One of the key elements of our firm are specialists of former real estate brokers, as well as some very proprietary databases that gives us access across North America to know what comparable veterinary, medical, and other dental practices or commercial real estate is available that could work for your needs, in strip malls, community centers, right, to large independent standalone buildings. Another key component is making sure that the annual escalations are focused, right? This can be commonly neglected, but landlords are very crafty of putting in provisions about CPI, right? Or in terms of the annual price increases, and link it to the annual inflation or CPI rates throughout the country, and therefore it can also be uncapped, or they'll even put limits that'll say it'll be CPI or a minimum of 4% to a maximum of 7%. So this can obviously escalate very quickly and can have a huge impact on your bottom line. The next component is operating costs, or also known as CAM, or Common Area Maintenance. You're charged for this, and it is clearly defined as to what you're responsible for and what you are not. Most of you on this call may be responsible for your HVAC, your heating, ventilation, and air conditioning system. So if something goes wrong, that is your expense. However, many of you that have negotiated it, in most cases the landlord should be covering that aspect of it. Or what else is incurred throughout the space, and depending on what percentage of the overall space you have, will be your individual responsibility. However, we have seen, unfortunately, landlords use this as their open bank account, and that they can do whatever improvements they want for those of you with triple net leases, and can pass on all or the majority of those expenses directly to the tenants. And if you represent 30 or 50% of the space, you could, and they've just, for example, have redone some of the outside of the building or some of the ramps or potentially even the parking lot, they, depending on how your lease is provisioned, can pass on those expenses to you, and depending on, again, how the lease is written, that could be due within 30 days. So I had a call recently with a doctor who had unfortunately been hit with a $30,000 bill that was due within 30 days, or they could potentially be in breach of their lease. So one of the key suggestions and takeaways and notes from today are to make sure that you have the right to review the statements of the operating costs and to ensure that you have the ability to audit those. Very important to ensure that what you're physically paying for, that the landlord is required to provide invoices, and it's not paying for their brother-in-law's snow clearing company, which we had an example of not too long ago. So let's talk about operating costs in a little bit more detail. So improvements are made to increase the overall property value. Right? They can also include building repairs or replacement to some of the structural components internally. Right? We definitely want to make sure that they are not including any real estate broker commissions. Right? That you're responsible for the inside, they should be responsible for the outside. Right? Or professional fees. We're seeing landlords also trying to pass those type of fees on to their tenants for any sort of professional accounting, legal, or otherwise. Also, please ensure that it should not be, and is unreasonable in our opinion, for you to pay interest or principal on some of their individual business type costs, mortgages, debt costs, and beyond, as well as association fees, marketing, etc. So for common area maintenance, again, focusing on the cost reduction theme, some key components here to making sure that your CAM charges can fluctuate, but that we've also put in some specific limitations on, let it be insurance premiums, property taxes, and beyond, right? And that you can audit those CAM charges. And the one example I mentioned previously, especially for those of you looking to sell your business, and from that component, what I want to do is discuss this section. So take a quick second to review this. This is found in approximately 75% of veterinary leases. And this section, by definition, governs and defines your ability to sell or sublet your space, or in some cases even bring on an additional doctor, which could be deemed from a commercial real estate perspective as subletting the space. So let's find out where some of the key issues are and break it down in layman's terms. The first section to point out is the fact that in order to sell your practice, you must assign your lease. If you were to assign your lease, you must receive consent of the landlord. You will be deemed in breach of the lease if you have not gotten the written consent. Therefore, it puts their power in their hands. If you do not have a lease or you are month to month, your ability to sell the practice is virtually impossible because the banks and financial institutions want continuity and predictability. And to do that, they need to ensure that that doctor is able to be in that space for usually a 5 to 10 year period. If that doctor wants a 5-year loan, or if you want a 5-year loan, you're going to need to have a 5-year lease to ensure that the bank knows that you have the right to be there for that period of time. Same thing for 10 years. In addition, the landlord shall have the option to, 1, approve the tenant's request to assign the lease or sublet the premises, or 2, decline the tenant's request to assign the lease or sublet, or 3, to terminate the lease agreement upon the effective date of such proposed lease, assignment, or sublet. So for you, simply asking to transfer the lease to the new incoming doctor with the sale of your practice, they can terminate your lease just for asking. So if you're feverishly looking through your lease in front of you or trying to pull it up online, right, the assignment and subletting section, and we find this in approximately 75% of leases that we're asked to review. In addition, the landlord has the right to revise the minimum rent to be paid during the remainder of the term to the greater of the then current market rate, right, loosely defined, for the lease premises, or 15% greater than the current rent. So again, just in the sale of the practice, they have the right, at least it's 15%, right, or greater, in terms of the total amount of additional expense you can incur for the new doctor now to pay an increased rent just for taking over that space. Now ask yourself the question, will that impact your deal if suddenly now the rent of the practice that you're acquiring bumps, and is that the practice you want to acquire? Well, if it's not purely negotiated, that can absolutely happen. Another key component here is really looking at what happens and your responsibility, right? And in terms of the overall financials. So when looking at it in the essence of time, should the tenant, right, so if you're purchasing it, receive from the assignee or subtenant any rental income, cash, goods, or any form of consideration in connection with the assignment of this lease or sublet of the premises that is over and above the current base rental rates payable to the landlord in any fiscal year during the term of this lease, the difference between the annual rent and such rental income, cash, goods, or other consideration shall be paid to the landlord directly within 30 days of the tenant's receipt. So, can anybody guess what that means in layman's terms? That means simply, doctors, that when you sell your practice, and you sell it for each dollar that is above the base rent that you would owe for that space, the landlord is entitled to 100% of that. For those of you screaming into your computers at the moment, right, this is very common to see in leases. And landlords now, especially the large institutional, are using this to collect a percentage of proceeds. Why? How is this possible? The landlords feel that the value of your practice is not with your blood, sweat, and tears that you've put in over the past 5, 10, 15, 25 years. However, it is purely based on their location, their building, and their asset, not yours. And therefore, based on this, anything above the base rent that you receive, you sell your $1 million practice and you owe $100,000 in rent, right? They can deem, based on this language that you have signed, that they are deemed the difference between the two, or that $900,000. Critically component that you negotiate this properly. Last but not least, right, the landlord's consent in assignment and subletting, the tenant shall not be released of its obligations under the lease and shall remain liable for any failure of the tenant or its assignees or subtenants. So this means that even after you've sold the practice and you're enjoying retirement down in Florida or on the beach, you are still continually liable for the remaining term of this lease. This is very common to see and is negotiable. And the landlord's perspective is, well, why would you want to assign us and bring in a new tenant which you don't feel confident in their ability to pay the upcoming rent? So therefore, doctors, critically important that the assignment and subletting. Now this is just one, as you can see, one of the many provisions throughout your veterinary office lease. What you see in front of you is over a dozen of the 2 to 3 dozen specific components of your lease that we review and our in-house commercial real estate attorneys and lease negotiators focus on for each and every account and each and every negotiation. One of the final components and takeaways from today is time. Please look at your lease. Note the lease expiry date. Do not go into a month-to-month status. Your ability to sell the practice diminishes dramatically if you are in month-to-month, because you or the landlord within 30 days notice can say, thank you very much, have a nice day, we're done, please be out in 30 days or more, or less. Do not become an overholding tenant. In many cases, if defined in your lease, in the overholding section, could increase it to 150 to 200%. And the landlord can terminate the lease or evict you with just 30 days notice, right? Focus on this. The cost of this can be well over $200,000. So in the essence of cost savings, please ensure you look at the lease expiry date, or more importantly, the option to renew period, which is usually 6 to 9 months out. If you miss that period, your legal right to be in that space afterwards, right, or the ability to exercise those options rather, right, become null and void. So be very cautious with the option to renew date. So time is of the essence. This is something the landlords know very well. This is the stall tactic that happens in most negotiations, where the landlord, the ideal time for you is 24 months out. We suggest that all of you on this call, they're looking to negotiate their leases to start 24 months in advance. Landlords are taught in seminars like this one that 12 months out, right, should be the longest period. 8 months are better for them, or even better after the option period has lapsed. Gives them in the red zone the highest amount of leverage to negotiate, knowing the amount of time and energy it takes to relocate your practice, which can be anywhere from 6 to 18 months to build out and relocate and permit a new practice. They know this, and therefore they will wait till the last possible second before giving you a new lease. Do not allow them to paint you with that brush. For those of you that have seen it before, happy to discuss this with you individually. We, over the past 25 years and 10,000 lease negotiations, have developed a very robust and bulletproof practice to help ensure that we have a successful result for you. As you can see, we gather all the information from you to do a lease review, which usually takes about 2 to 3 hours worth of investment and time into looking at the real estate as well as the legal risks. We then do schedule a 1-hour call with yourself and your practice manager or otherwise to review the lease. We create a schedule. We review the commercial real estate comparables in your space. We develop with our team of consultants that I manage a specific real estate strategy, right? Then if you choose to retain us, we start the initial 10 to 15 hours focused purely on the negotiations of the financials, the base rent, the common area maintenance, all the other hidden costs that we touched on today. After that is all done successfully, then we start talking about all the legal components and making sure that you are protected from those hidden $100,000 traps in your lease. And last but not least, we ensure that we review the final lease with you after doing all the back and forth negotiations, right? And now have something, we can turn that lease into a big liability, into an asset for the practice. So for all those that are attending today, we're able to do a critical dates and risk assessment, a lease review. This has a value of approximately $1,495 based on the hours invested of approximately 3 to 4 hours, right? With that scheduled call, we will be able to go through your vision and plan, the traps, as well as get a good idea as to what your ideal lease should look like and how to create a successful negotiation and tactical plan for your practice. For all those who have registered today and are on this webinar or watching the recording afterwards, for 30 days after, we have the ability to offer that as a complimentary service. So please follow up, and there'll be some abilities at the end of the webinar to click some polling buttons if you are interested in receiving a complimentary lease review. So feel free to click through now on your mobile device or on your website. And from that perspective, we will follow up with you accordingly, and we'll follow up afterwards as well. Great. On that note, as we reach the midway point, it again is my absolute pleasure to introduce Andrea Chen. Andrea, as I expressed before, works with many doctors throughout the country in creating the specific plans to make sure that the business is set up properly. It helps from a tax perspective and making sure, let it be corporations, salary dividend mixes, estate and trust planning, and definitely covering some of the things top of mind, which is the upcoming tax changes. So on that note, Andrea, over to you.
Thank you very much, Eric. So Again, the purpose of today's presentation is really to update everyone on the recent tax changes in the Canadian tax rules since July of last year, and more recently, the spring budget. I am based in Toronto, so I'm going to focus in more on the Ontario tax rates and the Ontario PC rules. Having said that, we are a national firm and we have a niche team across Canada, so my partners across the country will tailor their planning and structures based on the province that you're in. There's going to be quite a bit of information just to, let you know right off the bat, but don't worry, we're not expecting you to do this yourself. There's tons of changes. So all successful vets have a strong team that helps them get through the process. So we're going to cover a few things today. First being a summary of the current tax rates, just to give you some context, a timeline of what has happened to our tax system over the last few years, the new TOSI rules, which affect income splitting between family members. So for our vets in Ontario, this will only affect you if you have a technical service company or holding company with family members as shareholders. And lastly, the passive investment rules introduced in February of 2018 as part of the spring budget. So for those of you that have a vet professional corporation or a VPC, this will likely affect you. So as you can see, the top personal tax rates are quite high in Canada, and they range between 47% in Saskatchewan to 54% in Nova Scotia. Now focusing in on Ontario, we are at the top end of that range with any personal income earned over $220,000 taxed at 53.5%. Let's contrast that with the small business corporate tax rates, which range between 10 to 18%, depending on the province you're in. In Ontario, any professional income earned below $500,000 is taxed at 13.5%. It used to be 15%. And the difference between the 13.5% and the personal tax rate of 53.5% is about 40%, which is important for our deferral discussion later on. Now, if you look at any corporate business income earned over $500,000, it's still taxed at the same rates pre- and post-budget. So in Ontario, it's about 26.5%. So again, let's compare that to the top personal tax rate of 53.5%, and the difference is 27%. Let's take a look at what has been happening to our tax system in 2015, since 2015, and tons have happened. So as part of the Liberals' 2015 election platform, they wanted to ensure that high-income earners do not have the ability to use the Canadian-controlled private corporations to reduce personal income taxes. In 2016, they included measures to prevent the multiplication of small business deduction in groups of companies. So for those of you who are practicing in partnership with other vets, this would have affected your corporate tax rates, which means that if you're caught under this new rule, instead of paying 15% tax or now 13.5% tax on small business income, you might have seen your corporate tax rates jump to 26.5%, basically wiping out the small business deduction that you would have otherwise had. Between July and December 2017, they made tons of revisions to what they were proposing in terms of tax changes, which created a lot of uncertainty for our vets. Originally, in July, they wanted to focus in on 3 tax saving strategies that small business owners were using and were specifically allowed to use in Canada. First being income splitting with family members. Second, the deferral of tax by saving inside a corporation. And third, the conversion of what would otherwise be salary or dividends into a capital gain. Now in October 2017, Finance decided to leave the conversion of income into capital gains alone because they couldn't deal with the unintended consequences. So we'll talk about this a little bit later because it does create a huge tax planning opportunity for those in the right circumstances. In December 2017, they finally announced new income sprinkling rules, which we'll go over in the presentation. Effectively, they imposed a reasonability test on dividends paid to related parties, unless you fall into specific circumstances. So note that these rules take into effect in 2018, so it is in effect now. Then most recently, in February of 2018, they proposed legislation for the passive investment income. And note that in either case, we don't actually have the legislation in front of us. So it's really difficult to do actual planning. We did what we could for our clients in 2017 to save them a lot of tax. So now it's time to think about new ideas on what to do with the new rules. You'll frequently hear TOSI being referred to when people are talking about the new income splitting regime. So TOSI stands for tax on split income, which is a term they're using to apply high tax on dividends paid to family members. This high tax basically means paying total tax of 53.5% between the corp and personal instead of the marginal tax rates of the existing shareholder. So, in terms of context, right, if you are able to pay a shareholder with minimal income, $40,000, it would save you about $15,000 of tax previously. Historically, when you set up your VPC, you wouldn't have been able to income split because in Ontario, only vets or their holdco are allowed to be shareholders. So for the vets that have technicians on staff or sell a lot of products, you may have set up another corporation to income split with family members. And prior to 2018, if you had minor children who were shareholders of these corporations, you would have avoided paying dividends to them because it triggers high tax on split income. In other words, you ended up paying the highest level of tax anyways, which takes away the benefit of income splitting with kids under 18. And in December 2017, Finance broadcasted or brought in the split income concept to not only minors, but everyone that is related to the owner of the business. So in December 2017, Finance proposed that effectively January 1st, 2018, there will be some bright line tests where TOSI will not apply. And this is a good thing. And also, additional guidance was given on how to apply TOSI rules for adults. Still, note that without the actual legislation, rules are extremely complex and subject to interpretation. So there are 4 specific bright line tests where TOSI will not apply. Remember, this is a good thing. First one is if the vet is 65 or older, then they can continue to pay dividends to their spouse. If the vet sells shares of his technical service corp or supply corp and qualifies for the capital gains deduction, which means you can still use family members' capital gains exemptions, ultimately saving you about $200,000 of tax per shareholder. So that's still available. Now, if the vet passes away, and the shares are given to specific family members as part of the will. For the family members that inherit the shares of those of the professional corp, he or she can essentially pay out dividends without triggering high tax. And finally, if shares of a company are received as a result of a marital breakdown, then TOSI would also not apply. You'll notice again that these are very specific circumstances that you would need to meet to not have TOSI apply. So if you can't meet those bright line tests, then you have to look into whether you can avoid TOSI by falling within a specific exclusion. There are 3 of them. They're a little bit more subjective, so we need to be careful when we're planning around this. So the first exclusion is when dividends are paid from an excluded business. This essentially means that the shareholder, they can avoid high tax if they work over 20 hours a week in the current year or any of the 5 years prior. The tricky part is that the onus is on the taxpayer to prove that this happened, which means that even if the family member actually worked at the practice, CRA could still challenge and disagree with you. Remember, previously, we never had to deal with this issue when dividends were paid, as long as the shares were subscribed for properly and cash was exchanged. The second exclusion is if the income or taxable capital gain was from the disposition of excluded shares. So as a professional corporation or a technical service corp, this is extremely tough to meet. You may be able to do some planning to convert that professional corp into another type of corp. However, we caution against doing this until we actually have the legislation in front of us. And in theory, if you sell enough supplies, this provision may benefit you. The third exclusion is when a payment qualifies as a reasonable return. So like in the July proposals, they split the shareholders into 2 groups, the 18 to 24-year-olds and the 25-year-olds. If you're between the ages of 18 to 24, you're allowed to earn a 1% return of capital invested. So in order to receive a $40,000 dividend, that shareholder would have had to contribute $4 million of cash into the corp. And most people aren't able to do this. If you're over 25, there is a reasonability test based on the amount of contributions the shareholders has made to the business to support dividends paid to them. You can earn a higher rate of return than 1%, but it doesn't specify the amount. Again, it is very difficult to meet this criteria. When you're thinking about tax planning, some key questions to ask are, do you or your family members work over 20 hours a week currently? How about in the last 5 years? Do you have the documentation to support this? And ultimately, are you comfortable with the audit risk? Is your spouse or a shareholder now so you can consider income splitting when you turn 65? If you're retired, can you draw funds from your RSPs until you turn 65 so that you can ultimately income split when you turn 65? Now remember that kiddie tax or TOSI doesn't apply to salaries. So is there a reasonable salary you can pay to your family members for work done? Some of you may already be doing this in your VPCs. Can you pay into your spouse's RSPs and have them wait 3 years? Take out the money from the RSP later. And note that this essentially uses up your RSP room, which may not be the greatest idea, but it's an option. Have you considered an individual pension plan to generate pension splitting opportunities? Do you have a capital dividend account to pay out a capital dividend to your family members? Because this currently is not caught under TOSI. And that family member, when they receive the capital dividend, can use the proceeds to invest and earn investment income in their hands, therefore income splitting. So there's, a myriad of ideas that you can think about using. I think, the trick is finding the one that works for you with the help of your accountant. You can also think about whether some of the existing structures still make sense. As a cost-saving strategy, you may want to simplify your structure now if they no longer have a purpose. Now let's talk about the spring budget that released new rules on holding passive investments inside a corporation. This is where if you have a VPC with savings inside, it will affect you. Note that generally speaking, if you're a vet that is looking to buy a practice or start your own practice and require practice debt, it still makes sense to incorporate, to have the debt inside the VPC because you have more after-tax dollars to pay down your debt. In July, originally the government was concerned that incorporated business owners had an unfair advantage by being able to use the corporate tax deferral. Remember, in the earlier slides, corporate tax rates on the first $500,000 of small business income is 13.5% versus 53.5% personally. So someone that saved inside a PC potentially had about 40% more to invest with. So if you're a vet that can save $50,000 a year before tax, by saving in the corporation as opposed to personally, you effectively reduce your total tax payable by about $20,000 a year. And that $20,000 in additional cash would have otherwise gone to the government, can essentially be used to invest. Now, the compounding effect on the investment returns are very powerful, and this is exactly what the government did not like. The original July proposals were really complex and had tons of issues. So in the spring budget, they basically proposed two things to simplify those rules. First being the reduction in the small business limit, and secondly, the refundability of taxes on investment income. So remember that currently, if you earn less than $500,000 of small business income, the corporate tax rate is only 13.5%. What finance has proposed is that for years ends starting in 2019, for every dollar of investment income over $50,000, the small business limit will be reduced by $5. So basically, if you earn over $150,000 in investment income a year, the small business limit will be eliminated, which means you're going to pay corporate tax on business income at 26.5% as opposed to 13.5%. Remember, even though it's not great that you're paying more corporate tax, the reality is that you still want to incorporate if you're saving because that rate is substantially lower than the 53.5% personal rate. So comparing that to the current rules, if you're able to save 40% more to invest with now, you'll instead have 27% more to invest with if you incorporated. The calculation of investment income is based on an associated group of companies. So they'll be calculating the investment income based on prior earnings as well. So if you have a December 31st year end, you will be the first group affected by this budget. And we'll need to think about how to manage your 2018 investment income to potentially bring it under the $50,000 rate. So note that the investment income is basically a combination of interest, rental income, capital gains, and dividends. We don't have a lot of clarity in terms of those definitions yet, but we're expecting to hear more. So if you're considering selling your practice via an asset sale, what's important to note is that the investment calculation does not include the sale of a practice building or goodwill, which is a good thing. And currently, our tax system aims to tax investment income the same way whether you're an individual or a corporation. And they do this by tracking a tax pool called refundable dividend tax on hand, or RDTOH. The investment income earned in the corporation is basically the same rate that you would pay personally if you invested it. So the RDTOH pool essentially tracks that tax paid in the corporation to make sure you don't get double taxed. When dividends are paid out to the shareholders and additional personal taxes are going to be triggered, the corporation would get a tax refund back based on what is sitting in that RDTOH account. So super technical, but basically, it's our integration system at work here. And there are essentially two types of taxable dividends that can be paid out from your corporation. They're either eligible or ineligible. And eligible dividends are effectively paid out of corporate earnings that paid the higher 26.5% tax. So to compensate for that, eligible dividends trigger a lower personal tax rate. Ineligible dividends are paid out of corporate earnings that paid the lower 13.5% tax, and therefore trigger a higher personal tax rate. So regardless of whether eligible or ineligible dividends are currently paid out, the refundable taxes are given. The 2018 budget basically is proposing that there will be two pools of RDTOH instead. So without going into too much detail, basically the dividend refund will only apply when non-eligible dividends are paid after 2018. The nice part with these set of rules is that, as much as it complicates things a little bit, there is some pretty simple planning that we can implement to effectively manage this RDTOH account. And we know that these rules are extremely complicated, even though they are better than what was originally proposed in July. In terms of planning, what you want to think about is if you could consider paying out dividends before 2019 to obtain a refund on your RDTOH. If you need a lot of money from the corporation, either for your annual personal spending or to pay off a mortgage, remember that the capital gains planning is still available. That was a third thing that the government was looking to get rid of back in July, and they stepped away from it. So in terms of context, and just to give you some idea of numbers, by doing a capital gains plan to take out, say, $1 million after tax from a corporation, you would save about $450,000 in tax in Ontario. Now remember, the legislation is still in draft, so it's best not to go through any substantial changes to your ownership until we have the legislation in front of us. There are quite a few things that still need to be clarified. Having said that, there's still lots you can do without substantially changing your structure. So, in summary, speak to your accountant. These slides are meant for information only, and, you want to look at your situation specifically and figure out what you can do to save taxes going forward. I know we covered a lot of technical information with tons of complex issues. We're happy to meet with you, so, feel free to reach out to us.
Excellent. Thank you so much, Andrea.
No problem.
Pretty incredible changes, especially those in Ontario, let alone the rest of Canada. So I would encourage all of you to reach out to Andrea and or your accountant as quickly as possible, and to ensure that you are properly protected. Planning is in place, and it certainly sounds like we know it exists today, and there's a whole lot of uncertainty in the future. So proper planning is certainly beneficial not only for your veterinary lease, right, but certainly for your corporations and a tax perspective, especially those looking to retire in the near future. So thank you again, everybody, for your time today. We are finishing a little early. I've got a little section for Q&As. Feel free, all the information in front of you. If you have any specific questions for us, feel free to enter it now into that dialog box on your mobile device or on your web browser. And also, you have access to some helpful online resources and white papers specific as veterinarian practice startup guides, practice relocation guides, office renewal guides, the guide to buying your first veterinary practice, etc., etc. If there are any outstanding questions, feel free to throw those in now. If not, we would be happy to follow up and see what we can do to help in your specific situation. Also, you can see on the left-hand side some of MMT's professional page on LinkedIn, as well as some additional services that they offer, and their website as well on the bottom left-hand corner. Great. If there aren't any additional questions, again, thank you again, Andrea, for joining us today. Feel free to reach out to her or I if there's any additional questions. And for those watching, the contact information will be included on the recorded version posted online over the next few days. Thank you very much, everybody, and have a successful and profitable and well-planned day.